Matron, take them away.
Okay guys, hope you're well. It's just early morning and I've been marking the charts up for you, as you'll have seen in the Discord. And I picked up a message about stops. Now, a little salute to Charlie there who brought this up. Now, stops is probably the most divisive part of trading, because if you get them wrong, it's going to cripple your account, and everybody has an opinion on them, sort of thing. You have them tight. Well, I don't like tight stops because I think it's death by 1,000 cuts. But there's a difference between tight and ultra tight. I mean, so if you're sub 20 pips, that's way too tight. It genuinely is. Because you're trying to time the top and bottom of the market perfectly. We know that doesn't happen. In fact, it's very rare. And if you can do that consistently time and time again, then you've probably got this cracked. However, in my sort of experience, that's not the case. Then you have wide stops. Now, wide is 30, 40, 50 pips. Now, there's a difference between a wide stop and a stupid stop. Now, if you have a stop that's 200 pips, well, that can be a little bit. But then again, it depends on the trade that you're taking. You see, if you're swing trading, you need a 200 pip stop. Why? Because it's an ATR, you know, and you're working on daily charts, so you have to allow that movement. Now, what I'll do is I'll go on the chart and I'll kind of illustrate a similar path to what I take. I work in zones. And what I'm trying to do is have two barriers between the price and the stop based on zones, okay? And the zones are made from market structure. So to give you an example, we'll whop on a screen and I'll show you. So if we just flick up, I don't know, FTSE for argument's sake, okay? It's all clearly mapped out. I can see what it is I'm doing. Well, the first part of my equation is if I go out to a daily, I want to see what's going on with a daily. All right, drop on an ATR and it'll show me. Well, this is kind of excessive at the moment because we've just had 2 news days. So if I come back here, this will give kind of the rough idea of what a normal ATR is. So the middle ground around here is approximately between 100, which is down there, to 105. So about 100 is an average ATR of the FTSE. Okay. So if I know that, and I come down to an hourly chart and I get this, I can start mapping in some zones. So let's just go back a couple of days away from the news events, because we've just recently had non-farm payroll, Bank of England, and the Fed. So they're exaggerated, and it's not normal trading circumstances. So we'll go through to last week when it was relatively just normal. Okay, and we know we're working on a daily ATR of around 100, which is normally about right. So where are we at? So this was Wednesday, middle of the week. Okay, so the first thing I need to do is figure out where the start of the day is. Well, I know that it is midnight. Okay, so it starts here, midnight. So we'll just for ease of figures and so I can remember where I'm at, I'm going to put a vertical line on just to the side of it so that I can see it. All right. Okay. 100 pips. This will define the range of the market. Okay. There's 100 pips. So where did this market start? Well, it started there. Okay. So I can just drop in a line, just something that I can clearly recognize. I'll just put it in purple for now. There. And then if I go 100 pips the other way, because it started there, and drop in said line. Okay, there we are. Right, between that purple line and this purple line is the range of the day. Because if it never looked back and it went 100 pips, it would come here. And if it never looked back going the other way, it would go to there. Okay, so that's defined the range. So let's make some gray areas on this. So there's a gray area. Now a gray area is where you know you're at the outer extreme. So I just drop that there, because if the price gets into here, there's a high probability you could run out of steam and then just come back. But if it breaks through this, you're probably on a trend day, like what you see on a news day. And if it goes through it, you're probably on the wrong side of the trade. So these are important. They define how far the market can actually move on a given time period or a given time day. Okay, so get rid of that. All right. So if I know that's midnight and I go through to midnight the next day, just so we can see a working day, shall we say. So what we were looking at. So that's Wednesday through to midnight. So that's there. This is our working day. So if you're looking at this, well, there you are. It went to its full range and then bounced away. Right? So that gave this grey area here, this and this, has actually defined the playing field that you're looking at. Okay, so you can see that. So let's build this down into kind of your working day. Started around 7 o'clock. Okay, so there you go. There's the European orbit here. And if you were working to sort of 5 o'clock, there's a full day. So we've now got a defined section here. All right. Now, what I'm trying to show you here is the extremes of the market that can either pay you or, well, not pay you, take money off. Right? So that is here. So at 7 o'clock, you make your analysis. What have we got here? So there's your 7 o'clock. There's your 8 o'clock candle. If you're looking for the continuation, well, there's a target. And you've obviously got your levels as targets as well. Okay. What about the other way? Well, we know that is about as far as it goes. So if you're entering the market here and that's in sight, you can have yourself quite a tight target. But there's a lot of space between here and there. A lot of space. Okay. And the market is entering here. Right? Why? Because there's your 7 o'clock candle. There's your 8. Personally, I don't like to trade 8 o'clock, as you guys know. So for me, it would have been down here. Okay. So if this is my 9 o'clock candle, and depending on how I'm looking to trade, well, say I was wanting to go long for whatever reason, and I can sort of see, well, there's a hammer, you know, hammer formation. It's broke a level. In other words, the level is held, and I'm looking to get up to here. Well, where would I place my stop? Well, I've got a barrier here, the level, and I know it's a strong level because I can see a solid and a dotted running on top of each other. So they've validated each other, knowing this is rock solid. And as you can see, right through the day, that level held. Right? So there was plenty of opportunity to get money here. My stop could be there, just on the other side of this. One structure, two structure. But let's just say I'm in and around here. Well, I can use these levels. So let me drill this down a little bit. So it's Wednesday the 19th. I'm going to take this right down into a 15-minute trading day, so we can kind of see what's going on. Okay. So you see a break. I'll give you some, these are all hypothetical examples, guys. They're not sort of, oh, this is how I would have traded or whatever. I'm trying to illustrate the market itself as to how and where to place some stops. So there's 8:15. This is 9. Okay. If this is 9 o'clock candle, all right, and I'm looking at this in the face, I already know that's the outer extreme of the market's move. Okay. So is going down into it a feasible option? Probably not, you know, because the high probability it's going to turn. I would need to see that broken before I look for any sort of continuations. Market has come up. It is broke said level, running up to the other level. Common sense trade, okay? And that would have presented itself on that hourly candle I showed you before. And you take your signal from your hourly and then fine tune on a 15. So where do you put your stops? Well, there's the break. Barrier 1, barrier 2, stop under here. It isn't out of the ordinary, you know, measuring tool. So you're entering here, you're putting your stop down there somewhere. It's about 40 pips, okay? Enter just a little bit at a time, stage backwards into here, and then if it breaks through, you're wrong. So you're lessening your exposure. And then you're targeting to the upper side, and it's not a million miles away from 1-to-1, which is your starting ground. But because you are staging backwards, you've reduced your exposure. That makes that greater than 1-to-1. Okay. And if you go through the Scruffy madness, you'll have seen that, and you'll have seen how it reduces the exposure and increases the upside. All right. So there's just one example, just based on this criteria here. Okay. Well, what if we're going back down into this, because we have seen this is retraced back up on itself? How do we know? Well, we can look at a fib for argument's sake. You can see the accelerant started up there. It got down to there. It's come to the 50. We know about 50% fib retracements, etc. So this becomes a good zone of entry. And then we're going to trail it back down to the 23 or back into this target point here, whatever. But as we go, we know if we enter here, we target in the 38 and the 23. Well, sure enough, in this example, kaboom, stalled on them points and hit your target point. Simple stuff, guys, simple stuff, right? So if I know that 50 line is my entry point or thereabouts, it would be the break, it would be this candle here, based on that fib push up and a move to the downside. Okay, again, these are just hypotheticals and to give you an idea. So if I'm entering in the market there, okay, break of that, so it'll be this candle that took me in, looking for the 23, which if I just put that fib back on just so that I can kind of illustrate that for you. Okay, just duplicate that. So we target in this area here. Why? Well, because they are structure points based on a clean structure point. Very, very simple. Entry, exit. Where is my stops? Well, I have a barrier, which is here. Okay, so what can I do? Well, if I'm breaking these into zones, as you often see, put in like a red zone for argument's sake and a green zone. Okay. There's the zone there. So there's barrier 1. Duplicate that up into the middle ground that we know balances out all the time. Okay. Okay. So what have we done here? Well, we know the center ground gets respected and it reacts as a pivot point between two solid areas. You know, you need 2 fixed points. 1, 2. Pivot. Okay, so the price will come up with a pivot and then pull away. If it gets on the other side of it, maybe it's going to continue and go up to that side. So again, if we enter in here, you have 1 roadblock, 2 roadblocks, 2 structure points. So again, look at your sort of risk. Even if you go to the outer extreme, which is up there, and you're going to average in up that way, so you are reducing exposure all the time, and then you pull that down to there. All right, it's a little bit inverse, but it's still, if you were targeting the baseline here, which, let's be honest, it got there anyway, it's almost 1-to-1, but you should be risk free before it gets down to there anyway. And if you are averaging it up, then it becomes a little bit, get more profit, basically, because you've reduced your exposure and you've increased your upside. Now you can be ultra wide, and that will be the other side of here. So what you've done is you've created zones within zones, and it's all kind of based on this arena, because you're expecting the price to stay between the 2 grey points. Why? Because 80% of the time it does, and the odd 20% that it does on the breakout and it keeps on going, you either want to be on the right side of that trade and riding it, or you don't want to be involved with it at all, because it isn't going to come back. It's just going to keep on going. So when you're trying to sort of fade it and get your retracements, they're the trucking days. They're the days it never looks back. Okay, so that's a broad stroke of stops to give you an idea of what to look at. But essentially, Charlie and the guys make certain that you can afford the stop in the first place. So the first question you want to ask yourself is, how much will this cost? And base it on the maximum position size, not the splits. So from the point of entry to where you think the stop is, work out how much that's going to cost you. So for argument's sake, if it's 40 pips and you're £1 a pip, it'll cost you 40 quid. Ask yourself, are you happy to lose that money? If you say yes, well, then you're already at peace with the market, and then you can go ahead. And then the way you work from that is you enter into the market small, so you're not going 100% point of entry. And then when the market does move against you, you can capitalize on that and get the extra coming back the other way. That's all about account protection and being sensible. But if you're hanging on to a loss, as some of you have, praying it'll come back, they're the days it'll kill your account. So I hope that helps you. I genuinely do. And if you're stuck, just ask, and I'll jump on the camera and I'll try and clarify it. Or if you're part of the Scruffy squad that comes into the Zoom meetings, we have Free for All Friday. We can address it on a Friday and we can talk through it, because during the week we're assessing the chart of choice, and for next week it's Cape. Okay guys, so I hope that helps. So trade well, keep your risk managed, but above all, do what you love and the money will follow. See you all in the next one.